Yeah, so first we just look at the money volatility. We call this the term structure. So this is just looking at the time component because even, professional traders tend not to use like a 3D surface. It's kind of hard to wrap your head around. So this one's very straightforward, right? So just for an at the money option, what is the implied volatility? And you can see that depending on how much time we have to expiry, that number changes quite a bit. The implied volatility goes from 55 all the way down to 45, back up to a high of 60. And this is the market's way of telling us, how much we can expect movement of the underlying security to vary over time. And there's a few good things you can see here. So, take that blue dotted line from 1 month ago. Whenever you have real slow, quiet times like we were having, although it seems like we're starting to get a pickup, when markets are rallying and things are good, you tend to see things get calm, daily moves get small. And in that scenario, options start to get cheaper and cheaper. But, market makers are not dummies. They're not, that doesn't mean that it's going to stay calm with small moves forever. So you'll often see this upward sloping structure that Fabio is pointing to here of that blue line. You can see that it's sloping upward, over time. And what that's telling you is, hey, things are quiet right now, but eventually it's going to kind of return to a more normal level. Then, we get this, now looking at the green line, the current value, what we can see is we're having a little pop right now. Suddenly, there's been a little bit more volatility, a quick sell-off, some concerns, some earnings problems for a few of the big tech stocks, and suddenly there's a little bit of a spike in the short-term volatility. But, that it doesn't seem to be a permanent feature yet. But then suddenly see this big spike. Well, that's the market adjusting for earnings announcements, right? So we've got earnings coming out in about a month here. And again, market makers are dummies. The market is pretty efficient. And so it realizes obviously that we'll get a big spike in volatility potentially around earnings announcement, and then it'll start to decline right back to that kind of long-term norm. You can see that in all these examples, the long-term kind of normal expectation of volatility doesn't change a whole lot, but the front end of the curve can tell us a whole lot. So we can use that, and we can, and again, going back to why this is important, even if you have no goals to be a complex options trader or trade implied volatility, you can really see what the market is telling you and translate it into words. So you can say, you can look at that blue line and say, things are quiet right now, but don't expect it to continue. And then when you look at the green line, okay, we've gotten a little pickup, but it's not permanent, except for, of course, when earnings come out in a month. And then we think we should get back to more normal period. Whereas if you see that long end of the curve, by the long end of the curve, I mean, that's 60 to 80 days. If you see that yellow line is, for an example, shifting up or the blue line shifting down, those are more permanent changes. The market's actually starting to tell you, oh, we think there could be a more, seismic shift in vol when you see that end of the curve move. So, you can really make informed statements about at least market's expectations. Obviously, expectations can and do change, but that's the first thing implied volatility tells you. Next slide. Next, the other side of the coin is skew, or taking into account that implied volatility isn't constant, for a given price. So what's going on here? So this is what I was talking about, fat tails, right? Things can move much further out than just a single implied volatility number can capture. And so you tend to see that implied volatility gets really high the further you move when you get really far from the strike price. So this orange line is showing you that when NVIDIA was around 880, 888, 886, if you went way down to like 600, you start to get much higher implied volatility. And when you go way up about to 1200, again, you start to get really high implied volatility. And what that's telling you is that nobody wants to sell what we call lottery tickets or teeny options, basically bets against a crazy event, because crazy events can and do happen. And so the implied volatility is typically higher out there on what we call the wings. And then you also typically see, and then for any given stock, the shape of this will change a little bit. And even for a single stock, it'll change over time. But the key here to take away is that volatility isn't, again, it's not just a fixed number. Like on the last slide, I showed you that it changes over time. This also shows you that it changes over price. So here, the market thinks as long as this kind of bull run continues for NVIDIA, it's going to just continue to chop around. It's going to be pretty volatile. But if the kind of earnings excitement ends and it settles back down to this 750 to 800 range, then we might expect volatility to decline pretty substantially. With the caveat that if we have a price collapse, maybe a bigger market collapse or something, then volatility could really pick up again. So it's pretty nuanced.